Welcome to The Explainer. Today, we're going to crack the code on a pretty serious topic in high finance, India's Alternative Investment Funds, or AIFs. Think of this as your crash course. By the end, you'll be able to walk into a room and sound like you've been doing this for years.
Okay, let's just jump right into the deep end. Picture this. It's your first big client meeting. They've got 10 crow to invest. They lean forward and they ask you about AIFs. Your whole reputation could be made in this moment. What do you say?
Don't sweat it, we've got you covered. We're going to structure this just like a real consultant's briefing. We'll go through 5 key sections: what an AIF even is, what the options are, the one critical catch you have to know, the super exclusive VIP level, and then, of course, the payoff for you.
Right. First things first, before you can give any advice, you've got to know the absolute basics. Let's build that foundation.
So, what is an AIF? The most important thing to get is that this is not your typical mutual fund that anybody can buy into. It's a privately pooled fund. A much better way to think about it is like an exclusive, members-only club for very serious, very sophisticated investors.
And inside this club, there are 3 key players running the show. First, you've got the sponsor. They're the ones who set the whole thing up, and they have to put their own money in. They need to have skin in the game. Then you have the manager, who's basically the driver, making all the day-to-day investment decisions. And finally, there's the trustee, who acts as the referee, making sure everyone is playing by the rules.
And just how exclusive is this club we're talking about? Well, this number really says it all. The minimum price of admission is 1 crore rupees. Right away, that tells you this isn't for the casual investor. It's the first big gatekeeper to make sure only serious players are at the table.
Okay, so your client is in the club. Now what? Well, they've got options. See, not all AIFs are the same, and this is where you, as a consultant, really start to add value by helping them navigate the 3 different categories.
The easiest way to explain this to a client is with a simple analogy. Just think of the 3 categories as different types of vehicles. Are they looking for a category I truck, something sturdy and built for long-term nation-building kind of projects? Or maybe a Category 2 town car for those smooth, stable private equity deals? Or are they looking for a Category 3 race car, a high-octane hedge fund built for speed and complex trading?
And this table here, it just lays out those differences perfectly. You can see categories I and II are pretty similar. They're focused on longer-term bets in actual companies, they can't put more than 25% in any one place, and they can't use leverage. But look at Category 3. It's a totally different beast. It's all about complex, short-term trading, so it has a tighter 10% limit, and, this is the kicker, it's the only one allowed to use leverage. That's what makes it the race car.
All right, this next part is where you are going to earn your consulting fee. Because the single biggest difference between these vehicles isn't just their strategy, it's how they're taxed. This is the catch, and it can make or break your client's returns.
So here's the deal. Category I and II funds, they're really tax efficient. They have something called pass-through status. The fund itself is like a clear piece of glass. It pays no tax. Instead, all the income and the tax liability passes directly through to the investor. But Category 3 is different. The fund itself gets taxed before any money ever gets to the investor.
And this pass-through thing, it's a huge advantage. It basically means you're not getting taxed twice, once at the fund level and then again as an investor. It's like you made the investment directly yourself. From a tax point of view, that is incredibly efficient, and it's a major selling point your client has to understand.
And this number, this is the massive catch for the race car. Because Category 3 funds are taxed at the fund level, they often get smacked with the highest possible rate, which is a staggering 42.7%. So that means for that race car to actually win, its returns have to be absolutely massive, because it's starting the race with nearly half its fuel tank already gone.
Now, just when you thought this world couldn't get more exclusive, well, it does. There's another level, an even more VIP tier. Let's talk about accredited investors and the special funds that are built just for them.
So, an accredited investor, or AI, is someone who meets these incredibly high income or net worth requirements. The regulator, CB, basically gives them a special certification that says, okay, you're sophisticated, you know what you're doing, and you don't need all the usual regulatory protections. It's like a license that unlocks a whole new level of investing. And this number is the key to that VIP room. It's called a Large Value Fund, or LVF, and it's an exclusive AIF that only accredited investors can get into. And the minimum ticket price? A massive 70 crore rupees. These are designed for making really, really big, high-conviction bets.
So what does that 70 crore get you? Well, in one word, flexibility. While a standard AIF has to spread its bets around with a 25% cap on any one company, an LVF can put up to 50% of its entire fund into a single investment. It's the strategic difference between buying a little piece of a lot of companies versus taking a huge controlling stake in the one company you believe in the most.
Okay, we have covered a ton of ground. Let's pull it all together now into your final briefing. These are the key takeaways, the things you need to have in your back pocket to sound like a pro in that client meeting, or, hey, maybe your next big job interview.
If your client remembers only 3 things from your meeting, make it these 3. 1. This is an exclusive club with a very high price of admission. 2. The category you choose is everything. It literally defines the entire investment strategy. And 3. The tax difference is not a minor detail, it is the single most important financial factor.
And for you, here's the real payoff. Get ready for these questions because they will come up. After this, you should be able to nail them. You can explain the town car versus race car difference, you can talk about the power of avoiding double taxation, and you can explain exactly why an LVF is the perfect tool for a major buyout deal.
So let's end right where we started, back in that meeting. With this framework, you're no longer just answering questions, you're asking the right questions. The vehicle you recommend? Well, that depends entirely on where your client wants to go. And helping them figure that out, that's what makes you a great consultant.